Mutual funds or stocks? It's a common dilemma every investor faces. Both are popular, but they serve different types of investors. So, which one's right for you? By the end of this video, you'll understand the key differences between mutual funds and stocks, and it will help you decide which one fits your financial goals best. Let's start with stocks. When you buy a stock, you own a part of that company. This can be exciting, especially when investing in big companies like Reliance Industries or Adani Enterprises. Here's an interesting example. If you had invested rupees 1 lakh in Adani Enterprises in 2021, your investment would have grown to 6.2 lakhs today. That's nearly 520% return in just a couple of years. But this is exactly how stocks work. While they can generate massive returns, they also come with high risk and volatility. The stock price of Adani soared as the company expanded aggressively, but it also faced sharp corrections due to market fluctuations. This is the essence of stock investing. It's a high reward but high risk game. A company's performance, market trends, or even global events can drastically affect stock prices. Remember the market crash in March 2020 during the COVID-19 pandemic? Stocks like Tata Motors dropped nearly 50% in just a month. That's why investing in individual stocks comes with risks, and it's crucial to have a high risk appetite to deal with those ups and downs. Now let's move to mutual funds. Mutual funds pool money from many investors to invest in a diversified portfolio of stocks, bonds, and other assets. This means instead of betting on one or two companies, you spread your investments across multiple companies. For example, the HDFC Top 100 Fund doesn't just invest in one or two top performing companies. It has a portfolio that includes large cap stocks like HDFC Bank, Infosys, ICICI Bank, and so on. So, if one stock underperforms, others can balance out the risk. While mutual funds might not give you the same returns as picking the right stock, they offer stability. Take the Parak Flexi Cap Fund. It has delivered around 18% annualized returns over the last 5 years. This means if you had invested 1 lakh 5 years ago, it would now be worth approximately 2.3 lakhs without the stress of constantly tracking market movements. But the question is, within the mutual fund scheme, who is managing all these investments? One mutual fund scheme could be managing the investments of lakhs of people. So who is deciding how much to invest and where? There's a professional called a fund manager who takes care of that. They decide where to invest the money to get the best returns. Let's quickly look at what this fund manager does exactly. Let's take the example of Ronak Onkar, one of the fund managers of Parag Flexi Cap Fund. It's important to know here that Parag is the AMC name and Parag Flexi Cap is the mutual fund scheme name of this AMC that follows a Flexi Cap investment strategy. So let's look at the list of responsibilities that Ronak has. Number one, he makes sure the fund follows the Flexi Cap investing strategy, which means he invests in small or big companies and adjusts the allocation based on the market condition. Number two, he looks for undervalued companies with a good business model to invest in. Number three, he manages the portfolio's risk, ensuring it's in line with the fund's objectives. Number four, he ensures that the fund is generating better returns than the Nifty benchmark and possibly the peers. Number five, he makes sure the fund complies with SEBI guidelines. So now we know what a mutual fund is and what a fund manager does. Now let's compare the two. With stocks, you have full control over which ones to buy and sell. You decide when to enter or exit. But with the mutual funds, a fund manager makes all those decisions for you. Stocks carry higher risk because you are directly tied to one of the company's successes or failures. Mutual funds, on the other hand, offer lower risk due to the diversification. If you're aiming for higher returns, stocks might seem more attractive. But remember, that high returns comes with high risk. Mutual funds, though, offer steady, balanced growth, especially for long-term investors. Stocks also require more research. You'll need to study company performance, track financials, and monitor market trends. For example, investors who bought shares of Adani Enterprises in 2021 saw their patience rewarded with enormous growth. But it's important to note the volatility that came with such stocks. Mutual funds, however, are hands-off. A professional fund manager does all the hard work, so you can sit back while your money grows. Costs also differ. Stocks have brokerage fees when you buy or sell, but there are no ongoing costs. Mutual funds, on the other hand, come with management fees known as expense ratio, which can range from 0.5% to 2%. These fees might slightly reduce your returns, but you're paying for the professional management. Let's look at who should invest in stocks. If you're a risk taker with a higher tolerance for market fluctuations, stocks could be a better choice for you. For example, those who bought Zomato shares during the IPO were betting on its growth in India's food delivery sector, which could lead to huge gains if the company performs well. But remember, this requires time, market knowledge, and the ability to withstand the short-term losses that you could face. On the other hand, mutual funds are ideal for those who prefer steady, long-term growth with moderate risk. If you're someone who doesn't have time to research individual stocks or monitor the markets every day, mutual funds are a better option. For instance, someone who invested in an ELSS mutual fund like the Axis Long-Term Equity Fund could not only benefit from tax savings, but also steady growth over the years. Speaking of taxes, this is where the 2024 budget changes come into play. If you sell a stock within a year, you pay 20% tax on your short-term capital gains. But if you hold the stock for over a year, you pay 12.5% on any gain made above rupees 1.25 lakh. However, for mutual funds, especially debt funds, the budget has made a big change. Debt funds will now be taxed according to your income slab, just like fixed deposits, without any indexation benefits. Equity mutual funds have the same tax rules as stocks, but there are ELSS mutual funds, which offer you tax benefits under Section 80C, allowing you to reduce your taxable income by up to rupees 1.5 lakh. So which is better, mutual funds or stocks? The answer depends on your risk appetite and financial goals and how much time you're willing to invest in managing your portfolio. Many investors, including experts, recommend a balanced approach, holding both stocks and mutual funds to diversify risk and optimize returns. Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high-performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign-up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert-curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching and goodbye.